David, I'm sorry, Dr. David Coe, and we're reading my book, Thriving at Nature's Pace, with my mum, and it's about a new approach to climate change. Very exciting. There's a whole playlist of this. Actually, I should put that into all the comments and so that people can get it from one episode to another, or start promoting it better. But anyway, I'm on the section on bond managers. We're talking about how investments work and how investments can help with Thrive Coins. And basically, Thrive Coins are made by leaving oil and gas and coal in the ground. And that makes it a new approach because the current approaches is about how we change the sources of the energy we use. But so far, what has happened is we've created new energy and we've carried on using the old stuff. So we haven't actually changed. We just have used more types of energy. So the idea of Thrive Coins is you can choose if you want to leave basically the energy you would use from oil and gas and coal in the ground, and if you do, you can change that into a Thrive Coin, so that incentivizes you in that way. And of course, it doesn't mean that you're going to have to rethink how you use your energy, because you are leaving energy in the ground. So it does mean that in one way or another, you're going to have to use a little bit less. So whether that's walking more places or going for runs, or simply turning the lights off when you don't need them, or more dramatically, how if you're running a business, how your business may think about what it's actually doing and finding a connection with its customers more directly so that it doesn't need to use so much energy along the chain and all of those things. And all of that changes the idea from simply thinking about using a different type of energy to actually thinking about what we do. And that's how it becomes much more relational. What do you do with your time? This is the question. That's what the ultimate boils down to. So anyway, bond managers are the next largest proportion of investments is in government bonds. They manage that. Governments issue bonds when they need to borrow money. The bond is an IOU that is tradable. Anyone registered as the owner of the bond will be paid the interest in the final redemption. The bond manager turns a sum of cash today by lending it to a longer dated stream of income with a final repayment of the cash lent at the end. Money is lent like this to companies and governments. However, governments are typically considered more reliable. About $38 trillion of investment money is invested in government bonds, and this was pretty much at the end of the year 2025. An investment manager overseeing a government bond portfolio can use Thrive contracts to create a new class of Thrive bonds. Governments need to borrow in any case to finance climate projects. In a climate changing driven stagflation world, growth is in stagnation, and even with the best intentions, governments may not be able to borrow at all. Thrive bonds can be an avenue that remains open if Thrive contracts are sold to nature and Thrive coins paid as part of the interest. Investors would be interested if this were tied to projects that they have particular interest in. For governments with oil and gas and coal, this allows them to borrow by not extracting. This demonstrates to the lender a government's commitment to putting a lid on climate change. For example, a government paying interest may supplement this with Thrive coins, earned by selling Thrive contracts on oil and gas and coal it may have. This makes it more attractive to the lender. Oil and gas and coal producing states can collaborate with non-producing states. Oil and gas and coal becomes a catalyst to multilateral cooperation and public-private financing. Governments can decide for themselves what they wish to do with any additional Thrive coins that would be minted. They can be given to households as incentive payments for them to adopt. It can be offered to help other countries as part of foreign development programs. In a climate-changing world, countries will need to support each other. This can be a valuable way to develop social capital on a national and international level. For investment managers, this kind of structuring is bread and butter. They buy and trade bonds and use structures to reduce and focus the risk of what they're investing in. This allows them to lend money to governments for the benefit of their investors. Thrive bonds commit governments to be part of lowering the climate risk to the economy and their own citizenry. This makes it possible to maintain confidence in the future. Without that, there would be no lending. Bond investment managers also facilitate businesses to borrow. There is about $35 trillion of investment money. This is looked after by corporate bond managers. These managers bridge the gap between companies that need money and the owners of the real money who can provide it. In a climate changing driven stagflation world, that's basically a world where inflation is high but growth is non-existent, a credit crunch is likely. This will make it difficult for companies to borrow. Thrive Bonds can benefit those who are willing to contribute their part. These can be used to develop specific projects to help companies transition their businesses from the reign of oil and gas and coal. So basically, that's the end of that section, and it's basically the idea that for people who are interested in leaving oil and gas and coal in the ground, there's always a bit of money around that they may be interested to lend to businesses who share that. And this allows them or to progress forward even when things are difficult along, knowing that they're both contributing in that way. So the next section is on private markets. So I think might just read a little bit of that. It's about a page long. So private markets. About $31 trillion of the investment money is distributed to a combination of venture capital, private markets, and hedge fund managers. These are specialists who are often involved in financing the whole range of entrepreneurial projects, from startups to building substantial infrastructures. A private market manager structures investments to the terms specific to individual projects. This may be, for example, to develop or improve a set of residential properties, to lay down fiber optic cabling for a city, or to develop a container shipping port. Unlike investing in a company, the project has an end. This may be when the improved residential properties are sold to a real estate investment trust, when the fiber optic cabling is passed on to the network company, or when the shipping port is passed into the hands of the entity that will run it. The investors are typically real money owners. This may be a sovereign wealth fund, a family office representing wealthy individuals, or more recently, pension funds. The money is invested through limited partnerships that are specific to each project. The investment manager oversees the group of projects through a general partnership. This setup allows the same investment manager to be involved in multiple projects and the investors in each project to be distinguished from each other. The investors often make commitments to provide additional capital if needed when the project progresses past milestones. This capital commitment is often referred to as dry powder. The money can be invested either as private equity or private debt. With private debt, the capital is lent to the project. As equity, the money is used to buy a share in the project. The difference is significant. If a project fails, lenders have a right to be paid what they are owed by dissolving the project and selling the assets. Equity partners typically lose all their money unless there's a value left over after paying down the debts. This places equity partners lower in the pecking order. However, the payouts to lenders are fixed and the payouts to the equity owners are unlimited. This means that if the project does particularly well, the equity partners get to benefit the most. Private markets account for $25 trillion of investments. Investment managers involved can benefit from Thrive contracts by structuring them into the projects themselves. In particular, private markets are where a lot of smaller oil and gas and coal owners operate. This allows them to be part of the Thrive economy. When the owners are governments, this opens up the space for engagements between the private and the public sector. Thrive coins minted in this way can further benefit other projects. It may be that the private equity and debt investors use the money that first bought the Thrive contracts to invest, and the government takes the Thrive coins that are minted to distribute. This way, both parties gain according to the benefits they themselves may want. Venture capital. Venture capital is another highly specialized style of investment management. This area of investment is smaller with $3 trillion in capital employed. However, it has played an important role in bringing about the rise of companies like iPhones, laptop maker Apple, the friends and family chat platform WhatsApp, and the fast fashion monolith Shine. These are all venture capital successes. They highlight how venture capital investments can be at the forefront of new and transformative industries. Again, the investors tend to be the ultimate asset owners like pensions, insurance, and sovereign wealth funds. Billionaires and other high ultra net worth individuals are also often venture capital investors. Venture capital managers help early businesses get off the ground. They finance them through difficult growth phases where it can be hard to get funded. They can also work with entrepreneurs in early stages. The venture capital managers help to bring talents and fundraising together with the intention of exiting as the ventures become independent companies. They offer their expertise in exchange for an equity share of the businesses and ultimately profit when the ventures become successful businesses. They help give the ventures commercial focus. For the venture capital manager, the key is spotting the innovation that fulfills a disruptive opportunity. Selling Thrive contracts to nature will create disruptions across the industrial and business landscape. They will prompt people, businesses, and communities to rethink their energy use. They can be particularly inventive and innovate novel uses for the Thrive coins to promote their ventures. This is a vast area of opportunity to venture capital managers. By promoting and incorporating Thrive contracts and coins into their investment model, they can stimulate a rich ecology of innovation. This can become a virtuous circle as fledgling ventures themselves investing in not extracting oil, gas, and coal to create value. Venture capital managers often talk about their portfolio investments to raise interest in the ideas. In this case, by pioneering and raising interest in Thrive coins, venture capital managers can bring widespread awareness that would support further innovations. So the final section, well, may as well go for it, is hedge funds. This is where I spent 30 years working in, so it's kind of okay. When everyone is advocating for their own investment genius, every project can sound like the next skyrocketing success. This is where hedge funds play a role. The investment management ecosystem has managers focus on every possible ways to pick winners. Hedge funds and macro hedge funds in particular can uniquely make substantial amounts of money by betting against the trend. Hedge fund managers may account for just $3 trillion of the $150 trillion of investment money. Again, this was 2025. But when they perceive the economics to be right, they can borrow massively to amplify their trade. This allows them to build up extraordinarily large positions that reward the managers and make them among the highest paid in the industry. Of all the investment managers, they're also able to bet on the collapse of a company, government, or even an entire economy. They do this by what is called shorting. This is where they will borrow assets from people who own them to sell at a higher price with the intention of buying them back at a cheaper price when they have collapsed. They will then return the assets and pocket the profits made. George Soros, for example, infamously broke the Bank of England with a trade against the UK's ability to stay within the European exchange rate mechanism. He saw the intended exchange rate levels as politically driven. Each country wants the best for itself, and the exchange rates did not express the actual economic ability of the countries to sustain them. He took a massive position against the exchange rate levels, forcing the countries to defend them beyond their ability. Literally, the central banks ran out of money trying to sustain the politically motivated exchange rate levels. This caused the RM to break and reset at more economically sensible levels. John Paulson's hedge fund is another that famously applied pressure to correct the financial markets. This was to correct mortgage lending industry. Excessive lending built up into a bubble in the decades leading into 2008. This inevitably burst and became the global financial crisis. However, bubbles do not burst without running into a sharp pin, and hedge funds like John Paulson's are often behind the pin. Bubbles can exist in individual companies too. Accounting can be creative and financials can be muddied. Carson Block's hedge fund Muddy Waters specializes in identifying large companies that have become big by misrepresenting their financials. It then establishes a large short position before making the information public to force the value of the company to correct. Hedge funds make money by timing their bets on the direction of sentiment versus fundamental economics. The two interact and ultimately fundamental economics wins. However, along the way is a case of putting together the pieces of a puzzle and finding the catalyst that can trigger a big move. There are plenty of commentaries about how climate change will hurt people's savings. However, contrary to received wisdom, markets rarely if ever take notice of risks. They follow the people who are making money. That means progress needs people to make money by speculating with Thrive contracts and Thrive coins. Hedge funds are inventive and unrestricted in their activities. They can certainly use Thrive contracts to make money on the one hand and bet heavily on the other. Contracts and coins are new tools for them to create pressure to open up the cracks in the rain of oil and gas and coal. For all investment managers, supporting and promoting Thrive contracts will increase their opportunities to benefit their investors and themselves. So there you go. That's the end of that chapter. Thank you for everyone. The next one is how economics works. And then we'll finish this sort of section. So we can do that maybe tomorrow. What do you think, Mom? So that was my job.
Yeah,
但係嗰度
但係如果你睇中嗰個 market OK 嘅喎，如果 market 唔升嗰陣時咪弊。
係啊，咁 my mom is saying if you can spot when the market's going up, you're okay. But if it doesn't go up, it's bad. But that's where hedge funds come in. They go short and bet the other way. They bet they go down. So most people can only buy the shares. Hedge funds can sell shares they don't have and buy when the price falls. So it's quite risky because the share price can go up, and then what happens is you're forced to close down your position at a loss. But it does mean that when they think that everything is overpriced, you start seeing hedge funds selling the market and going short it in that way. And then derivatives instruments which can help them do that and so on. So it'll be interesting to see what happens. At the moment, because the market's basically just the same money, there's only one way for it to go. But the idea of Thrive Coins is that introduce a new sort of money. So you can actually have the Thrive Coins do well. In other words, people may buy more things with Thrive Coins, and they will see inflation in the money that they would currently use. So it's quite possible for that to happen, and that would be an interesting scenario to check.
咁而家啲電台係咪想啲人即係急錢？每個電台都話每個星期有個 cash price 喎，叫人哋
Yeah, so a lot
bet on
a lot of electronic trading people
it.
want people to trade a lot,
Yeah.
so they offer cash prices because for them,
Half
whether
of
you-
a million, they do it.
yeah, but whether you make money or you don't, you still pay them. So they only care that you trade.
Yeah.
And so if the market's not doing well, they offer prices so that you have an incentive to go and trade.
即係有一個人中啫，
即係有一個人做，但係其他嗰啲人個個人都要俾錢㗎嘛。
唔係啊，
你要 trade 嗰陣時。
個個人都要俾
So
錢。
everyone has to pay their commissions and their fees, so they make more money no matter whether you lose money or not. But what matters is that you trade. So the market is not really doing well or going up. They offer you prices like a lottery price,
Yeah.
so that you basically enter by trading. So the more you trade, the more chance you have of winning a prize. But when markets are going down, you lose more by what you actually buy. So you buy a share for 100 and that goes down to 50, but you win $1 back. And that's kind of how it works. But the win feels good. When you win in that way, it feels good. When you lose, it goes down to 50. You say, oh, I'll just hold on to it. And it goes down to 25. And then what they do is then they will probably often close you out, because a lot of people buy on margin rather than just buy with cash. They buy by borrowing from the companies. So if it goes down enough, they will close out your position and charge you the fees as well.
仲衰咗添。
Yeah. So they always win in that way.
Yeah.
But okay, thank you everybody. So stay safe, invest wisely.
即係都係揾笨。
Just remember it's your money.
Yeah.
So don't lose it. Okay, bye bye.
Bye.